SLR, which means statutory liquidity ratio, is yet another quantitative method for controlling credit in the hands of RBI. SLR, which means statutory liquidity ratio, is basically the percentage of funds every commercial bank has to keep as a reserve with itself from its time and demand deposits before giving loans and advances to its customers. Now I'll explain. Every commercial bank has to keep some amount of reserves as a percentage of its demand and time deposits before it gives loans or advances to its customer. Which means every commercial bank has to keep some amount as cash reserve ratio to RBI and some amount with itself before giving the remaining amount for loan. I'll explain this. Let's say a commercial bank has 100 rupees with it in the form of time and demand deposits, which it can give to loans to its consumers. However, some part of it, let's say 5% goes as CRR, cash reserve ratios, and 5% will go as SLR, that is statutory liquidity ratio. That 5% has to be kept by commercial bank with itself in the form of liquid assets. Liquid assets are assets which easily get converted into cash, like gold, government securities approved by RBI. Now what happens? Out of 100 rupees of deposit, 5% goes with RBI, 5% has to be kept in the form of liquid asset. So now the commercial bank only have 90 rupees to distribute in the market. So higher the SLR, statutory liquidity ratio, lesser will be the funds available for the commercial bank to circulate in the market. So the less money circulation will happen. Lower the SLR, that is statutory liquidity ratio, the more money will be in the hands of commercial bank to circulate in the economy. So by this way, with CRR and SLR, government controls the money circulation in the economy.